Okay, pay attention. All the perquisites which are there, we have already covered all of them. 17 subsection 2 is perquisites. Clause 1, clause 2, 3. In clause number 3, 5 perquisites. Yes or no? Then clause number 4, 5, 6 and clause number 8. In clause number 8, these perquisites were there. Yes or no? Fringe benefits. And additionally we have covered medical facility and leave travel assistance also. Yes or no? Now we are supposed to do clause number 7 and clause number 7A. 2 more perquisites are remaining that we are going to cover little later. But first let me complete the provident fund concept for you. Which concept? That is the last concept in this chapter. Okay, no? So first we'll do provident fund concept. Okay? See. Provident fund is a retirement benefit. If you all know. Hello? How many retirement benefits we have already covered? Gratuity we have covered. Pension, leave encashment and VRS compensation, then retrenchment compensation. These things we have already seen. Right now? Apart from that, there is a concept of provident fund also. Now see, what is the meaning of provident fund? Provident fund is a retirement benefit. Now, in provident fund, what happens? There is a provident fund account which your employer has to open for you. So your employer opens a provident fund account for you. In that provident fund account, employer will contribute from his pocket. Employer will have to contribute from his pocket, and you also will have to contribute in your provident fund account, because this is an account which is made for your retirement. Later on, after you leave the job, after 10 years, 15 years, 20 years of your employment, okay, at that time you will be in need of money, because for example, if you retire at the age of 60, so at the age of 60, you will not be in a condition to work regularly, because you are already old. You would require some funds at that time for your medical treatment, your your children's marriage, etc., to buy a house or to repair your house. At that time, the fund requirement will also be huge. Money requirement will also be huge. But at that time, you will not be in a position to earn money, because you are already grown old. So that time, till that time, why don't you save some money from, today itself? So start saving money from today itself for your old age. And that money which you save will be saved in a fund known as provident fund. So that money you are going to save from your income, from your salary income. So employer is going to give you what? Tell me. Salary. Employer is going to give you what? From your salary income only, you are supposed to save something for yourself, for your future. Now tell me, if your salary is rupees 1 lakh, and if this entire 1 lakh is given to you in your hands, and I am telling you, take this 1 lakh, and from this 1 lakh, start keeping some amount, separately. Start saving some amount separately for your old age. Will you save some amount for your old age? If I'll give you 1 lakh fully, usually what will happen? Entire 1 lakh you will spend only. Hello? And even if you know that you would require some money in your future, you will not save some money right away. Even if you will save, you will spend it. So there is a separate account which is made. In that account, what I will do, I am your employer. From your salary only, some amount I will deduct. I am not going to give you full amount in your hands. Because if I will give you full amount in your hands, what you are going to do? You are going to spend that entire amount. And it is my responsibility. The law has given a responsibility on me to make sure that you are saving out of your income, and I am also saving something for you. So there are laws in India, PF laws in India, Provident Fund law in India, which compels the employer, that employer will have to make sure that you are saving out of your income. And employer is also making some contribution in that savings. Understanding or not? So, if the law tells me to make sure that you are saving out of your income, and if I will give you the entire income, will you save out of that income? So, to ensure that you save out of your income, I will not give you full income. Out of that income, I will deduct some amount as your contribution to your provident fund. So, for example, if your salary was 1 lakh, if your salary was, I will deduct 10,000 out of that. I will deduct 10,000 out of that. How much I will give you in your hands? So 90,000 net salary you will get in your hands. Whereas your salary was 1 lakh. But how much amount you are getting in your hands? 90,000, do whatever you want. But the 10,000 rupees of your salary, which I will deduct, I am not going to keep that amount with myself. There is a separate provident fund account created for you. In that provident fund account, that amount will be deposited. So the deposit is made in the PF account. Out of employee salary only. Can I say this is employee's contribution out of his salary income to his provident fund account? So one PF account is made. Come on, tell me. One PF account is made. Provident fund account is made. This is for the future. Okay. Future, you will get money out of this account. Whenever you will retire, whenever you will grow old, at that time you are going to get amount from this provident fund. So to get the amount from this fund, you have to first do the savings. You have to first deposit the amount in this fund, no? So from where the amount will be deposited? First you contribute here. Employee, contribute. How will you contribute? Out of your salary income, no? So I am giving you salary. Deposit out of that salary. Will you deposit? So should I give you full salary? Or from salary, I only will deduct some amount. So whenever the employer is going to give you what? Salary, out of that salary, the contribution to PF, your contribution to PF, I will deduct that. And that amount will go to your PF account. Yes or no? And the net amount, what did I say? Net amount will be given to the employee. Understanding or not? Now as an employee, tell me, as an employee, how much was your salary? 1 lakh. How much got deducted? 10,000 got deducted. How much money came in your hands? So under the salary head, under the how much salary you will show taxable? Full 1 lakh. How much is your salary? Out of that 90,000 is coming in your hands and 10,000 is going as your contribution to your provident fund account. Yes or no? This is known as whose contribution? This is your contribution out of your salary. This is employee's contribution. Employee will have to contribute. And I will have to make sure that you contribute to your PF. Okay. Now, will I also contribute? Do I have to contribute? Yes. The law makes it compulsory for me also to contribute some amount in your provident fund. So now in your provident fund, two amounts are there. Number one, out of your income, your contribution is there. And out of my pocket, my contribution for you is also there. Yes or no? Now this amount will be accumulated. This amount will be every month. Your salary, some amount will be deducted and that will go to PF. Every month, some amount from my pocket also will go to your PF. Every month salary, some amount will be deducted. Meaning, for the full year, whatever salary I will give you, from that salary I will deduct your contribution and it will be deposited, and from my pocket also for the full year some amount will be deducted. This will happen for the first year, this will happen for the second year, this will happen for the third year, till the time you will be with me in my employment. Yes or no? Till that time, every year this will happen. Understanding? Now every year what will happen, on periodic intervals, whatever balance is there in the PF account, on that balance also interest is credited. Interest will also be, it is just like a bank account. In the bank account, if you put your money, on that money interest is credited, no? So just like that, your money is getting accumulated in this account. Some money out of your income, salary income, some money out of your employer's pocket. The money which gets deposited in this account, on that money, on that deposit, accumulated balance which is there in your PF account, on a periodic intervals, interest is also credited. So interest will be credited on the total employer's contributions also and total employee's contribution also. Yes or no? So on the entire amount standing to the credit as a balance, on this amount some interest will also be credited on a regular basis. Now three amounts are coming in the PF account. First amount is employee's contribution is going in the PF account. Second one is employer's contribution is going in the PF account. The fund is increasing. The money in the fund is increasing. Every month, every year, out of your salary, some amount will be contributed. Out of your employer's pocket, some amount will be contributed. On your contributions also, interest will be credited. On employer's contribution also, interest will be credited. This will slowly and gradually, your PF account balance will keep on increasing. It will keep on increasing. And after some time, whenever you will retire or whenever you will leave the employment, at that time whatever balance is there in the PF account, that balance is known as lump sum. Accumulated balance in the provident fund account. That accumulated balance is given to you at the time of retirement or separation. See, first three arrows are there going in. Can you see three arrows going in? Number one, employer's contribution is going in. Number two, employer's contribution is going in. Interest is going in the PF account. And one arrow will come out. One arrow will come out. Now entire balance which is there in the PF account, meaning the lump sum amount. Now don't you think this lump sum will contain your contributions so far, employer's contributions so far, interest on your contributions, interest on employer's contribution? This entire balance is known as what? Lump sum. Now this lump sum will go out. The money which is there in the PF account will be coming out of PF. When this money will be given? Right now or in the future? In the future you will get what? Lump sum. Who will get the lump sum? Either the employee will get on his retirement or separation, or employees nominees. Employees nominees will get that amount on the death of the employee. So whatever balance gets accumulated in the provident fund, whatever balance which gets accumulated in the provident fund, that entire balance, that entire accumulated balance is given to the employee on his retirement or separation. Or if he dies before his retirement or separation, then on his death the balance is given to the nominees. Yes or no? Now this is known as retirement benefit. This is known as, this will be given right now or in future. So let's have a discussion about the tax treatment. that how the tax treatment will happen. In the future, whenever you will get this amount or whenever your nominees will get this amount, will that amount be taxable or that amount will be exempt? But that depends on the type of provident fund. The tax treatment depends on the type of provident fund. Now this provident fund can be of three types. It can be statutory provident fund, it can be recognized provident fund, or it can be unrecognized provident fund. Any of the provident fund, the things are remaining same. Employee will contribute, employer will contribute, interest will be credited, and lump sum will be given. Yes or no? Four things are constant. Number one, employee will contribute, employer will contribute, interest will be credited, and lump sum will come out. Yes or no? But the provident fund can be different provident fund. Provident fund can be statutory provident fund. Provident fund can be recognized provident fund, or the provident fund can be unrecognized provident fund. Now what is a statutory provident fund? What is a recognized provident fund? What is an unrecognized provident fund? First you understand the type of provident fund. Then based on the type of provident fund, the tax treatment will be decided. Understanding? So please check this diagram. See, who is this? Who is this? Employer is giving gross salary. To the out of the salary income of the employee, some amount will be deducted as provident fund contribution. So out of the income of the employee, some income is deducted and that income will go to the provident fund account. This is known as employee's contribution. This is known as color, blue color. Yes or no? Color, which color? Blue is blue color, yes. So, next one, will the employer also contribute? Will the employer also contribute? So, employer will contribute from his own pocket. This is known as employer's contribution. You have to be very careful, huh? Identify what type of contribution this is. Oh, this contribution is deducted from employee's salary. So, this is employee's contribution. Oh, this contribution is coming out of the pocket of the employer. This is employer's contribution. Now the amount will be accumulated in the provident fund account. Now whatever accumulated amount is there in the provident fund account, on that, on periodic basis, interest will be credited. Quarterly, half yearly, yearly, on a periodic basis, the interest will be credited. Now the amount will keep on accumulating. Amount will keep on. And whatever total amount, accumulated balance, known as lump sum amount, okay, that will be given to the employee on retirement or separation, if he retires before his death. But what if he dies before his retirement? Then on his death, the amount is given to nominees. Right? Now see, there are how many types of provident funds? Three types. First one is, second one is, third one is. What is statutory provident fund? Please read, everyone, in chorus. It is a provident fund which is set up and administered by as per the provisions of PF Act 1925. This type of provident fund is applicable to the employees of government, universities, recognized educational institution or specified institution. Now there is a law in India. What is the name of that law? As per this law, one provident fund is already set up in India. Who is running that provident fund? Who has set up and who is running that provident fund? Government. So government has a setup and government is administering a provident fund as per the requirement of this law. And that provident fund is applicable for what type of employees? All the employees of government. This means that this fund is created for the benefit of government employees, employees of universities, employees of recognized educational institution or specified institutions. So for the benefit of these type of employees, a provident fund is set up and administered by the government as per the provisions of Provident Fund Act 1925. That type of provident fund is known as statutory provident fund. What type of provident fund? So earlier the benefit of provident fund was available to only these type of employees. But later on in 1952, in which year? One more law came into existence, and the name of that law was Employees Provident Fund and Miscellaneous Provisions Act 1952. Now as per this law, any employer in the private sector will have to make sure that his employees are also contributing to Provident Fund. Now, only the employees of government, universities? No. For other employees also, the contribution should happen to Provident Fund. And this was the requirement of another law. And what was the name of that law? Employees Provident Fund and Miscellaneous Provisions Act 1952. So as per the provisions of this law, a provident fund which is set up and administered by an employer in the, so employer is in private sector. Now the employer is not government. Now the employer is not university or some educational institution. No. Now the employer is any employer in the private sector. Now that employer will have to also set up and administer a provident fund for the benefit of his employee. And that type of provident fund will be known as Recognized Provident Fund, RPF. Usually what happens, an employer having 20 or more employees. How many employees? At any time during the year. So during the year, if I am having 20 or more employees, it becomes compulsory for me to set up and administer a provident fund for the benefit of my employees also. I will have to make sure that even my employees do participate in provident fund. Yes or no? But for that, I am not going to make a separate fund. I am not going to administer that fund. A fund is already set up by the government. Yes or no? What I will do? I will get one account open for each of my employee in that provident fund. Getting my point? Hello? So what I will do? I will go to the government and I will open a provident fund account of each of my employee with the government's provident fund. So that provident fund is as good as set up and administered by me only. No need to get it recognized separately. No need to get it approved separately. Why? Because the provident fund account maintained with the government only for each of my employee. So that provident fund will be automatically, it will be treated as recognized provident fund. So employer is in which sector? Employer is in which sector? So this employer will also have to set up and administer a provident fund for employees. And that provident fund will be known as recognized provident fund. But setting up a provident fund, running it is not everyone's cup of tea. It is a very huge responsibility. You might not be able to take that responsibility as of now because you just have 20 or more employees. Yes or no? So do one thing. Don't set up your provident fund separately and don't administer. Do one thing. Open a provident fund account of each of your employee with the government only. So just like the government employees are having a provident fund account with the government, with the government only, open a separate provident fund account for employees. Now that account which you are opening for your employees will be as good as the provident fund is set up by you and administered by you. We will treat that provident fund account as your recognized provident fund only. Understanding? No need to get the separate approvals, no need to get the separate recognition. Because we know that you have opened a PF account for your employees with us. Understanding? Tell me yes or no. Now, if in any organization, with any employer, if the number of employees is 100 or more, how many? Now that employer can set up his own provident fund account. Instead of opening a provident fund account of each of their employee with the government, now a separate provident fund account can be maintained by the employer himself. Now what the employer will do? Employer will set up a separate provident fund account. Employer will administer this separate provident fund account. Now to do that, a trust will be created. What will be created? A trust will be created. In that trust, representatives from the employee side will come and representatives from the employer side will come. They will become the trustees. They will become the... So these trustees will be the responsible people to run this entire trust. Now on the name of this trust, a provident fund will be created. And this provident fund is a private provident fund which you are setting up for your employees. But you can do it only if you have 100 or more employees and unanimously all the employees agree to set up such type of provident fund. Yes or no? Now this provident fund is a private provident fund. Go and get the fund approved with the commissioner of PF. There is a commissioner of provident fund. So first you will have to get the provident fund approved with the commissioner of provident fund. Once he gives the approval, then your provident fund needs to be recognized by the income tax department by satisfying certain conditions. So first you will have to take the approval of PF commissioner. Which commissioner? And once the PF commissioner approves your provident fund, then that same provident fund you will have to get it recognized. You will have to get it recognized by the income tax department. Income tax department will put certain conditions. If you satisfy those conditions, then your provident fund will be recognized by the income tax department. Then it will be known as recognized provident fund. So first of all, you have 20 or more employees. How many employees? Employer in private sector. Employer in private sector. You have 20 or more employees. Are you required to set up an administered or provident fund for your employees? Yes. But no need to set up a separate provident fund. Do one thing, open a provident fund account for each of your employees with the government. No need to get it separately approved. No need to get it separately recognized. By default, it will be treated as a recognized provident fund. Because it is opened with the government. Because it is opened with the understanding. What if you are having 100 or more employees? You can set up and administer your own provident fund. But for this, all the employees unanimously should agree for setting up and administering own provident fund. And now that own provident fund will be made on the name of trust. Trustees will be given the responsibility to run the trust and to run this provident fund. Yes or no? So a trust will be created. On the name of the trust, the provident fund will be created. Yes or no? Who will be the trustees of the trust? Representatives of the employee and representatives from employer side will become the trustees. And now these trustees will run the trust. And on the name of this trust, now a separate provident fund account can be created. But this can be created only if 100 or more employees are there and all the employees unanimously agree for opening such type of provident fund. Now in that case, a provident fund account will not be open for each of your employees with the government. Now your provident fund account of each of your employee will be opened with this trust in this separate PF account. Yes or no? But what will happen? This provident fund which is set up and administered privately by the trust. Yes or no? Separate approval has to be obtained from the PF commissioner and it has to be recognized also by the income tax department, and income tax department will give the recognition based on certain conditions. Hello? Then this provident fund will be known as recognized provident fund. Did you understand the meaning of RPF? Did you understand the meaning of RPF? What is RPF? RPF is a provident fund which is set up and administered by an employer in the as per the provisions of Employees Provident Fund and Miscellaneous Provisions Act 1952. It is recognized by the Commissioner of Income Tax and applicable to the employees of private sector and public sector undertakings. PSUs means public sector undertakings. Will you remember this? Sure. Now what are the provisions of Employees Provident Fund and Miscellaneous Provisions Act? The provision says that separate account for each of your employees should be opened with the government if you have 20 or more employees. No need to get it separately recognized or approved. That fund will be treated as RPF by default. Yes or no? But you can open your employees provident, you can open the PF account of your employees privately in your fund also if you have set up your provident fund on your own. But that can be done only if the number of employees are 100 or more and the provident fund is created on the name of trust, which is approved by the PF commissioner and recognized by the Commissioner of Income Tax. Done, sir? Now there is one more fund known as unrecognized provident fund. Which fund? Unrecognized means a fund is created by the employer in private sector only. It is approved by the PF commissioner but not yet recognized by the income tax department. So till the time the income tax department is not giving the recognition, the provident fund will be treated as unrecognized provident fund. Yes or no? This is not an illegal fund. This is a legal fund only. But income tax department is yet to give the recognition because certain conditions needs to be satisfied by you. Those conditions are not yet satisfied, so the fund is not yet recognized. Once the conditions etc. will be fulfilled, the fund will also be recognized. But till that time the fund will be unrecognized. UPF. Will you remember this? So whatever type of provident fund is there, what did I say? Whatever type of provident fund is there, whether it is SPF or it is RPF or it is, we are going to talk about four things. Number one, employees contribution. Number two, employers contribution. Number three, interest credited. And number four, lump sum coming out of the provident fund. Lump sum will come right now or in the future. So let's see in the future whenever the lump sum is coming. What did I say? In the future, whenever the lump sum is coming, lump sum will come in the future on retirement or separation to the, or it can be given on the death of the employee to the, see whenever the lump sum is given, lump sum accumulated balance in the provident fund account, whenever that amount is given to nominees on the death of the employee, in the hands of nominee, the amount is fully exempt. That amount is not taxable because that amount is given on the death of the employee. Understanding or not? But what if employee does not die? Before the death only he retires or separation takes place. He leaves the employment or he retires. Then on his retirement, on his separation, the amount will be given to the employee himself. So the amount from provident fund, accumulated balance in the provident fund in the future will be given to the employee on his retirement or separation. So at that time, will that amount be taxable in the hands of the employee? The answer is no. It will be fully exempt if the lump sum is given out of Statutory Provident Fund. So in the future, you are getting lump sum amount, accumulated balance from your SPF account. So the money which was going to the SPF account, that accumulated balance in SPF account is coming back to you. So in the future, whenever you are going to get what? Accumulated balance from your SPF account, that amount will be fully exempt under section. Can you get the amount from your RPF account? For you, SPF was not maintained. What was maintained? RPF. So definitely the balance which was there in your RPF account will come back to you. That will also be fully exempt under section 10 subsection, subject to certain conditions. So if you fall under any of the following situations, only then the amount coming from RPF will be exempt. Understanding? Conditional exemption is there. First of all, tell me, amount is coming from SPF. I'm talking about right now or I'm talking about future? Whenever you will retire, whenever you will be separating from your employer, at that time your employer will give you accumulated balance of your RPF. Take this balance is accumulated in your provident fund, take this amount. On your retirement, on your separation, whatever balance is there in your provident fund, take it away. So the lump sum amount, the accumulated balance is given to you as a retirement benefit. And that amount is coming from SPF, fully exempt, nothing will be taxable. That amount is coming from RPF, fully exempt under section 10, 12. But if that RPF balance, you want to claim it exempt, it will be exempt provided you fall in the following situations. Now certain situations I will tell you. Okay. If you fall under any of these situations, only then the RPF balance coming to you will be exempted. Otherwise, it will be assumed that the balance is not coming from RPF, it is coming from UPF. It will be assumed as if the balance is coming from UPF, and it will be taxable in the same manner in which UPF balance is taxed. Which means that if the balance is coming from UPF, that balance will be taxable. So in future, you are getting money from the provident fund, retirement benefit. Hello, where are you getting money? You are getting money from SPF. You are getting money from fully exempt. 10 subsection 11, no condition. You are getting money from RPF, fully exempt under section 10, 12, provided you fall under any of these situations. Okay. What if you don't fall under any of these situations? What if you don't fall under any of these situations? Then the amount coming from RPF will be assumed as if it is coming from, and it will be taxable in the same manner in which the amount of UPF is taxed. This means that if the amount is coming from UPF, balance is coming from, the balance of UPF will be taxable. And it will be taxable in 4 parts. It will be taxable in, now tell me one thing. Every year, will you contribute? Employee's contribution will go. Every year, employer will also contribute. Every year, interest will be credited. That entire amount will get accumulated. And that accumulated amount will come to you. Understanding or not? So can I say my accumulated balance, my lump sum amount consists of 4 items. Accumulated balance or the lump sum amount will consist of 4 items. Number 1, your contributions so far. So starting since the beginning till today, whatever contributions which are made by you, from the beginning till today, whatever contributions are made by your employer, interest on your contributions, interest on employer's contribution, all these 4 amounts will be clubbed. Total. This is nothing but lump sum. This is nothing but lump sum. This is nothing but accumulated balance. So can I say in your accumulated balance, 4 items are there? In your accumulated balance, 4 items are there. Number 1, employees contributions starting till today. Number 2, interest on employees contribution. Yes or no? Number 2, employers contribution starting till today. Whatever employer contributions are there and interest on employers contributions. So you just have to bifurcate your lump sum into 4 parts. You just have to bifurcate your lump sum into 4 parts. Your lump sum will contain 4 items. Number 1, employees contribution. Number 2, interest on employees. So whatever contributions are made by the employee, interest on that contribution. Yes or no? Number 2, employer's contribution and interest on employer's contribution. Whatever contributions made by your employer, interest on that contribution. Yes or no? Now you have to bifurcate your lump sum into 4 parts. Now tell me, from where you have contributed? First year salary, fully taxable. From that salary only you have contributed. Second year salary, fully taxable. From that salary only you have contributed. Third year salary also taxable. From that salary only you have contributed. Meaning that whatever contributions are made by you, your employees' contributions were made from your taxable salary only. The salary which has already suffered tax, from that salary only the contributions were made, and these contributions are coming back to you. Cannot be again treated as your income. IGNORE. So in your lump sum, what did I say? In your lump sum, whatever employee's contribution was there, which is coming back, that was made from your salary only. First year salary, second year salary, third year salary, entire year's salary. Hello? The salary which has already been taxed, out of that salary only, every year the contribution was going, and that contribution is again now coming back to you. Your contributions out of your taxed salary, which was there in the provident fund, is now coming back to you. Will not be again considered as your income. IGNORE. Ignore. So out of the lump sum, some amount will be ignored. What amount will be ignored? So many years, whatever contributions you have made, no, those contributions are coming back to you, no, ignore them. Why? Because those contributions are already considered as a part of your income, and those already have suffered tax. Understanding? Everyone. But on these contributions, whatever interest is coming, that interest is your income. But it will not be taxable under the head salary, it will be taxable under the head other sources. Why? Because out of your salary income, amount was contributed to your provident fund, investment was made in your provident fund, on that investment only this return is coming. So any return on your investment is nothing but your income, taxable under the head IFOS. So after a few years, whenever the money will come back to you, after few years, whenever the accumulated balance will come to you, accumulated balance means lump sum, and that lump sum is coming from UPF. Bifurcate that lump sum into 4 parts. Number 1, in that lump sum, whatever contributions of the employee are there, what will you do? Ignore. Interest on employee's contribution, don't ignore. This is your income. This will be taxable under the head IFOS. But what about in that lump sum your employer was also contributing? And interest was also credited on your employer's contribution, yes or no? So instead of giving that amount to you as a salary, employer contributed in your provident fund, and it is coming through provident fund. But ultimately the amount is coming from the pocket of the employer only, no? Whether that amount is given to you directly or it was put in your provident fund, and from provident fund that amount is coming, meaning that the amount is coming from the pocket of your employer only. So employer is giving you profit in lieu of salary. This is profit in lieu of salary. Instead of giving you salary, this type of profit is given to you. Understanding? So whatever employer contributions are made so far, and the interest on those contributions, entire amount will be treated as profit in lieu of salary and will be taxable under the salaries head. Will you remember this? So tell me, if I talk about lump sum, are you going to get this lump sum right now or in the future? First of all, lump sum is what? Accumulated balance. Yes or no? Lump sum is what? 4 parts. Accumulated balance has 4 parts. All the parts are fully exempt. Yes, if the lump sum is coming from SPF. If this lump sum is coming from, lump sum has how many parts? 4 parts. Yes or no? No need to bifurcate into 4 parts because this entire lump sum is fully exempt. Because it is coming from SPF. So if the lump sum is coming from SPF, then fully exempt. If this lump sum is coming from RPF, then also fully exempt, provided you are covered in certain situations. I am going to explain them right now. Okay, no? So if you are covered in certain situations, then even the lump sum from RPF coming, no need to bifurcate into 4 parts, fully exempt. But if this lump sum is coming from UPF, if this lump sum is coming from, you will bifurcate into first part. Employees, what will you do? IGNO, interest on. What will you do? Taxable under the head. Third and fourth part. Employer's contribution and interest on employer's contributions. Yes or no? Both the amounts will be treated as profit in lieu of salary under section 17 subsection 3 and will be taxable under the head salaries. Will you remember this? But sir, how much amount will be treated as employee's contribution? Out of the lump sum, how much amount will be treated as interest? None of your business will be given in the question. They will give 4 parts of the lump sum. They will say 10 lakh lump sum is coming. How much lump sum is coming? In that 10 lakh, this much was employee's contribution, this much was interest on employee's contribution, this much was employer's contribution, this much was interest on employer's contribution. You just have to give the tax effect, that's it. The amount they will give you in the question directly. Can you give this treatment? Right now you are supposed to give this treatment or in future? In future this treatment don't give to lump sum from RPF. Sorry, lump sum from SPF. We'll have same 4 parts. But no need to bifurcate, no need to give the tax treatment as taxable. Getting my point? Entire lump sum will be exempt. No need to bifurcate the lump sum from RPF also, provided you are covered in certain situations. Then your RPF lump sum will also be exempt. Understanding? But if the lump sum is coming from UPF, you will have to bifurcate your lump sum into 4 parts like this and you will have to charge it. Right now or in the future? Sure, no? Now in future, what if this lump sum is coming from RPF? Will it be exempt? Yes, provided you are covered in following situations. Okay, so first of all tell me, this accumulated balance to the credit of provident fund account, meaning the lump sum amount. Future, it is coming on the death of the employee to the nominees. It will be fully exempt. If this accumulated balance or the lump sum amount is given on retirement or separation to the employee, it is coming from SPF, it will be fully exempt. Coming from RPF, it will be fully exempt. Coming from UPF, it will be taxable in 4 parts. These 4 parts you all know now. Okay. Now see, note. Accumulated balance to the credit of, did I say PF account or RPF account? We are talking only about So from RPF if the lump sum is coming, from RPF if the lump sum is coming on retirement or separation, will that lump sum be exempt? The answer is yes. That is exempt under section 10 subsection 12. But wait, it will be exempt only if the employee has rendered a continuous service of 5 years or more with the employer. So employee, lump sum is coming from RPF. Employee, lump sum is coming from RPF. You want your lump sum to be exempted. So tell us, how many years of services you have given to your employer? Before getting this lump sum, you might have given your services to your employer, no? Have you given the services of 5 years or more? Yes. And then you are getting this lump sum. Fully exempt. Then it will be fully exempt. Meaning, a requirement is there that the employee must provide a minimum employment, minimum services of 5 years or more to the employer. And only after that he is getting the lump sum from RPF, only then it will be exempted. So first question will be, employee has rendered a continuous service of 5 years or more with the employer. If the answer is, then the lump sum coming from RPF will be fully. But if the answer is, it should be taxable. But still it will be exempt if the reason for leaving the employment within 5 years was beyond your control. So have you left within 5 years? Yes. So the lump sum should not be exempt. But wait, still we will exempt if the services are terminated due to any reason beyond the control of the employee. The reason for leaving the employment, reason for termination in your employment was beyond your control. Hence you had to leave within 5 years. Then also your lump sum will be exempted, even if it is coming within 5 years. So first of all, first requirement is lump sum should come after providing a services of 5 years or more. Then it is confirmed, it is exempt. Yes or no? But what if you have provided a services of less than 5 years? The lump sum should not be exempted. But still it will be exempt. If your employment or services are terminated because of any reason which was not in your control. For example, you have just completed 3 years of service. How many years? Meaning less than 5 years. And within 3 years you have to leave the job because you become sick. So sick that the doctor has advised you not to travel and not to do anything else. Complete bed rest. And because of your ill health, you have to leave the employment. The reason is in your control or beyond your control. And because of that, within 3 years you have to leave and you are getting the lump sum. In that case, it will be exempt. What if the company has sold the business? You have been with the company for 3 years. And now the company is getting amalgamated with some other company. Company has sold the business. So the business of the company will go away. That new company is taking all the employees, taking all the business but not taking all the employees. And because of that, your job, you have to leave within 5 years. Reason is in your control or beyond your control? Beyond your control. Company is going for a liquidation. Reason is in your control or beyond your control. So there are many things, many reasons which cannot be in your control, and because of those reasons, if you have to leave within 5 years, and as a result of that you are getting that lump sum, then that lump sum will be exempt, even if it is coming within 5 years. But what if the reason was beyond your control? No. Reason was in my control. I have resigned. If you resign, means reason was beyond your control. No, you have resigned on your own. You have left your employment on your own. Then then the lump sum should be taxable. Still the lump sum will not be taxable if the balance standing to the credit of your RPF account is not taken by you. It is transferred to your new employer. Then also it will be fully exempt. So after leaving the employment, within 5 years, you are joining some other employer. And that other employer was also required to maintain your RPF account. So instead of opening a new RPF account with that new employer, you get the old RPF account and the balance transferred to your new employer. Are you taking the money in your hands? Or you are getting it transferred to the new employer? Now your new employer will continue maintaining that RPF account. Getting my point? The balance will not come to your hands. Rather, the balance and the old provident fund account will be transferred to the new employer. Now that new employer will not make a new provident fund account for you. Your old provident fund account will be continued by him. Now whatever contributions he is supposed to make, he will make the same contributions in that same account which was earlier maintained by your old employer. Getting my point, everyone? So in that case, have you left within 5 years? Yes. Reason was beyond your control? No. Then also the amount can be exempted provided the lump sum is not taken away by you. That lump sum, the accumulated balance to the RPF account is transferred to the new employer. Understanding? But what if it is not transferred to the new employer also then? Then at least transfer it to NPS account of the central government. So central government has a scheme, National Pension Scheme. Get your RPF balance transferred to National Pension Scheme of the central government. Don't take that amount in your hands. Get it transferred to NPS account. Then also it will be exempt. But sir, see, I left my employment within 5 years. Meaning 5 years or more service is not given. I left within 5 years. I am here. Reason for leaving was in my control. Reason for leaving was in my control, meaning I am here. And I have not got the amount transferred to the new employer. I have not got the amount transferred to NPS. Then definitely the amount is going to come to your hands. Have you worked for 5 years or more? No. Oh, reason was beyond your control. No. Reason was in your control only. You have resigned. Hello? Oh, then you are getting the amount transferred to your new employer. No. Oh, then you are getting the amount transferred to NPS. No. Then bloody the amount is going to come to your hands only now. Within 5 years, the amount is coming in your hands now. This is known as premature withdrawal. This is known as, and now it will be assumed as if the amount is coming from UPF. And this amount which is coming in your hands within 5 years, yes or no, this amount will not be exempted under section 10 subsection 12. It can be exempted only if services are given for 5 years or more. Even if you are receiving, it will be exempt. Even if you are receiving within 5 years, it can be exempted if the reason for leaving the employment was beyond your control. Beyond your control? No. Then also we can exempt it provided you don't take the amount in your hands. You get it transferred to your new employer. Or not new employer, then at least get it transferred to NPS. Don't take the amount in your hands. But what we are seeing, you have not worked for 5 years or more. You are working for less than 5 years. Not getting the amount transferred to NPS. Not getting the amount transferred to your new employer. Reason was also in your control to leave the employment. And still you are getting the amount in your hands. Now this is known as withdrawal from your provident fund account. And this is premature withdrawal. Within 5 years you are withdrawing the amount from your RPF account. And this premature withdrawal will not be exempt under section 10-12. Even if it is coming from RPF, we will assume as if it is coming from UPF. And the UPF balance is taxed in 4 parts, this balance will also be taxed in 4 parts. Employees' contributions, ignore. Interest on employees' contribution, taxable as IFOS. Employers' contribution and interest on employers' contribution, taxable under the head salary as profit in lieu of salary. Will you remember this? Everyone, look at this entire table first. Come on, fast. First of all, one by one. Tell me, I will scroll. You will read, I will scroll. Read it. Employee has rendered services for 5 years or more. If the answer is yes, then RPF balance coming will be exempt. If the answer is no, second question, come on. Employee's services are terminated due to any reason beyond his. If the answer is, then also the amount will be exempt. If the answer is, next question, balance standing to the credit of RPF account is transferred to his individual RPF account maintained by his, meaning the balance is transferred to the new employer. If the answer is, then also the amount will be. And if the answer is, next question, balance standing to the credit of RPF account is transferred to his NPS account referred under section. If the answer is yes, then also it will be. And if the answer to this question is also no, starting from here, no, means now the amount will be received by you in your hands. And this will be premature withdrawal. And it will be taxable as if such balance is coming out of UPF account. And how the balance from UPF account is taxed? In 4 parts. Just like this. Will you remember this? Now tell me, I am giving you one situation. Huh? Give me the answer of this situation. This is X Limited. Can I say he was your old employer? And with X Limited, you had worked for 3 years. How many years? Meaning within 5 years you left the employment. You were ill? No. Company closed? No. Amalgamation, etc.? No. Reason was beyond your control? No. Meaning you have resigned. Oh, reason is in your control. You are leaving the employment on your own. Very good, very good. Now with X Limited, you had a RPF account. This RPF account has some balance. Now, what if you get this balance transferred to your new employer? Your new employer is Y Limited. Your new employer is Y Limited. Can I say new employer Y Limited? You have got the amount transferred to your new employer. Instead of taking that amount in your hands, you preferred that this amount should be transferred to your. So the moment it will be transferred to your new employer, it will be fully exempt because the amount is not taken in your hands. Understanding? Now who will maintain this account? And with new employer you are going to work for another 2.5 years. Now 3 years contributions in the Provident Fund account were made by X Limited, and in that same Provident Fund account additional contributions for 2.5 years will be made by. So after total how many years? Now that balance will come to you. So the balance is coming to you after how many years? So even if it is coming after 2.5 years, but still it is coming after 5 years or more, then also it will be fully exempt. Understanding? So once the amount is transferred, at that time it is exempt. But what if with the new employer also you are not working for more than 5 years? Then don't just check the number of years service with the new employer. Because new employer is not maintaining a new RPF account, he is maintaining the old RPF account. So old RPF account was maintained for how many years earlier? 3 years. and that same account, same balance is maintained by new employer for 2.5 more years, 2.5 more years, yes or no? And after 2.5 years he is giving. Now from Y Limited, the lump sum will come. Now from Y Limited, the lump sum will come. But the lump sum is coming to you after 2.5 years. No, it is coming after 2.5 plus 3. Total 5.5 years, which is 5 years or more. In this case also it will be fully exempt. Yes or no? But wait, if you had worked only for 1.5 years, then the lump sum is coming after 4.5 years, which is less than. Now in that case, the lump sum here will not be exempt. At the time of transfer it will be exempt, but after 1.5 year when you will receive it, at that time it will not be exempt. Taxability will be in 4 parts. Will you remember this? Sure. Pay attention. See this. See this. Note. Services with X Limited is services for how many years? Less than 5 years. Example, 3 years. Example, RPF balance is transferred to. So when it will be transferred, it will be exempt. Now in the above case, later on RPF balance is received from, then services with X Limited plus services with Y Limited, total number of years will be checked. Now the total number of years will be checked with Y as well as X. If that total number of years is 5 years or more, in the first example it was 5.5 years, if you remember, then the RPF balance coming from Y Limited will be fully exempt. But if the total number of years, X plus Y, total number of years is less than 5 years, then RPF balance coming will be taxable in 4 parts, as if it is coming from UPF. Will you remember this? Hello sir? Okay. Now this was your tax treatment. Tax treatment of what? Tax treatment of what? Accumulated balance. See, I am making a provident fund account. Everyone will focus here. This is a provident fund account. First amount will come inside. Employee's contribution will come from his. So this is employee's contribution. Every year this amount will come. And then every year employer will also contribute. Employer's contribution will also come. Every year interest will also be credited on a periodic interval. Now the amount will keep on accumulating and the amount will go out. What will go out? Lump sum. Lump sum means accumulated balance. That lump sum is coming out. The discussion about this part we have already done. This will come today or in future. So what will happen in future, we have already discussed that. If the lump sum in the future is received from SPF, will be fully exempt. If the lump sum in the future is received from RPF, will be fully exempt in those situations which I have told you. If lump sum in the future is received from RPF after providing services of 5 years or more, then it will be fully exempt. What if the services are provided for less than 5 years? Then also it will be exempted, provided the reason for leaving the employment is not in your control. And if the reason was in your control, then also it will be exempted, provided the amount is transferred to new employer or the amount is transferred to NPS account. But if nothing like that happens, that means within the period of 5 years, the amount will be withdrawn by you. That is known as premature withdrawal, and that will be taxable as if the amount is coming from UPF. And UPF balance is taxed in 4 parts. Number 1, Out of the UPF balance, accumulated balance, employees' contributions, ignore. Interest on employees' contribution, taxable under IFRS. Employer's contribution and interest on employer's contribution, both amounts taken together will be treated as profit in lieu of salary, taxable under the head salary. Will you remember this? Now this is something which you will do in the future. But to get this amount in the future, in the current previous year, what you are supposed to do? You are supposed to contribute. Your employer will also, and interest will be credited in the current previous year. Last previous year also this happened. Last to last previous year also this happened. This year also this will happen. Next year also this will happen. Every year this will happen. Till the time you don't retire. So tell me, every year, what did I say? Every year, will you contribute? Where? To your provident fund. From where you will contribute? Your salary is 1 lakh. Out of that 1 lakh, 10,000 you are contributing in this year. This year. So now I am talking about our previous year. In our previous year 25, 26, will you contribute from your salary? So that in future you get lump sum. Yes or no? So to get the lump sum in the future, in the current previous year, you will have to contribute from your salary was 1 lakh. And out of that salary, 10,000 what? Deducted. That is nothing but your contribution out of your salary. So this year, how much salary will be taxable? 1 lakh fully taxable. Meaning the moment you are charging 1 lakh under the head salary, this 10,000 is already considered there as your income. No separate treatment under the head salary needs to be given. Because entire 1 lakh salary is taxed and that 1 lakh already includes the 10,000 contributed to Provident Fund. Yes or no? So separate treatment of that 10,000 contributed out of your salary to your Provident Fund, any separate treatment of that amount under the head salary is not required. But wait. Out of your 1 lakh rupees of salary which you have shown taxable this year, 10,000 you have contributed means invested in your provident fund, no? For that you are going to get deduction under 80C. Which section? But after calculating your GTI. So first calculate your GTI. In your GTI, show your salary 1 lakh, yes or no? And in that salary, from that salary, 10,000 is already contributed to your provident fund, no? That is your investment in your provident fund. For that you are going to get deduction under 80C. So what will you do about your contribution? In this year, you are contributing to your provident fund. SPF, RPF, UPF, any provident fund you will contribute. Will you give any separate treatment under the head salary? For your contribution, will you give any separate treatment under the head salary? No. Why? Because the entire salary is getting taxed. From that salary only your contribution is going. So no separate treatment required under salary head. Only one effect to be given. Only when you will calculate your GTI. When you will calculate your, from that GTI, you are going to get the deduction for this contribution under section, but provided the contribution is happening to SPF, provided the contribution is happening to RPF and not to UPF, because that provident fund is not yet recognized by the income tax department. Department will say, we don't recognize the provident fund, then how come we give the deduction? We will give the deduction only if you contribute to your SPF, only if you contribute to your RPF. But will not give you any deduction if you contribute to your UPF. Everyone, understanding? Read this part. Tax treatment. What did I say? Tax treatment of various amounts in case of different types of provident fund. First is employees' contribution to SPF account, RPF account, UPF account. No need to give any separate treatment under salary head. Okay, no. Only take the deduction under 80C. But don't take the deduction under 80C. If your contribution out of your salary is going to UPF, for that you are not going to get any deduction under 80C. Take the deduction under 80C only if your contribution is out of your salary in your SPF account, or your RPF account. Only then for that contribution you are going to get the deduction under ATC. Yes or no? Your contribution discussion is done. Now who will contribute? Sure. Will your employer contribute to your SPF? Fully exempt. Will your employer contribute to your UPF? What? UPF? Yes, fully exempt. Will your employer contribute to RPF? Yes, exempt if the contribution is up to 12% of your salary. And any contribution made by your employer to your RPF account over and above 12% of your salary will be treated as your salary. Excess amount will be treated as your salary and that will be taxable. Now the important discussion is this. All of a sudden you gave me a look. The moment I said employer contributed to UPF, employer contributed to, amount will be fully exempt. You say, UPF, how come exempt? Now please understand the logic. Now tell me, this year, have you contributed? Employee, have you contributed? Now your employer will also contribute or not? So, let's say statutory provident fund is there. Which provident fund? Who is setting up or administering this fund? Government will set up and government will administer a provident fund for the benefit of their employees. Hello? Meaning, the fund will be set up and administered by the government for its own employees. Statutory provident fund. Just tell me, just give me one answer. Government will always contribute more or whatever is required. Simple. Even if you will tell the government, please contribute more, no for me. Will the government contribute more for you? Government, give me less salary and the salary which you are not giving me, contribute that salary as your contribution to my provident fund. Will the government ever do that? Government will say, silently take whatever salary we are giving to you and whatever contribution which are supposed to be made to your statutory provident fund, only that amount we are going to contribute. Nothing more, nothing less. Whatever contributions the government will make to your SPF account, whatever contribution your employer means government will make to your SPF account will always be a genuine amount. Will never be more, will never be less. It will always be the required amount which will be contributed. Yes or no? So don't you think that the contributions which the government will make, don't you think that the contributions which the government will make to your SPF account, to your, that contributions will be always genuine amounts. The amount which is actually required will only be coming out of the pocket of your employer and going to your SPF account. Hence that amount is exempt. Reason is that? No. Reason is not that. Reason is something else. Are you an employee? If I give you salary, then it should be taxable, no? And do you remember salary is taxable on due or receipt? Whichever is earlier basis, no? Employer is contributing. Employer is where? In your provident fund account. Is the amount becoming due right now to you? Or it is just contribute? Employer will just contribute to your provident fund. The amount which is contributed by the employer neither becomes due in this year and nor it is received in this year. So why should it be taxable in this year? When this amount will become due? When it will be received? At the time when you will retire. At that amount as a part of lump sum, this will become due and at that time only you are going to receive. So its taxability should not be right now. Its taxability should be at the time when it will become due or received. Yes or no? Which is not going to happen right now. It is going to happen in the future. In the future, as a part of lump sum, this contribution will become due. And it will be received at that time. So should it be taxed right now? No. Why? Because employer is just contributing. Employer is just, and that contribution which the employer is making right now is neither becoming due right now, nor it is received right now. So fully exempt. As a part of lump sum, it will become due, and as a part of lump sum, it will be received. At that time also, it will be fully exempt because it is from SPF. Genuine amount contributed will become due. Genuine amount will be, which is contributed, will be received as a part of lump sum. Hence, that entire lump sum is exempt, coming from SPF. Because whatever lump sum you are going to receive from SPF will be the genuine amounts contributed by the government, genuine amounts deducted from your salary, genuine amounts contributed as interest. Getting my point? All those genuine amounts accumulated will become due, will be received at that time, hence it will be fully exempt at the time of your retirement or separation. Hence that SPF lump sum was fully exempt. Will you remember this? So tell me, SPF lump sum in future it is exempt. SPF lump sum in future. But to get that lump sum your employer will contribute right now. So is your employer contributing to your SPF? Is your employer contributing to your SPF? He is just making that contribution right now. The contribution in this year made by your employer neither becomes due right now, nor it is received right now. So it should not be taxable right now. It will become due as a part of lump sum. It will be received as a part of lump sum. At that time it will be fully exempt. And right now also it is not taxable because it is a genuine amount. Understood? Yes or no? Sure. Let's go to UPF. Let's go to, I'm not talking about RPF. I'm talking about, is your employer contributing in this year? Now he is contributing to UPF. He is just contributing, no? Is the amount becoming due right now? Is that amount is received by you right now? When that amount will become due? At that time it will be taxable. 4 parts. Employer's contribution, interest on employer's contribution, interest on employee's contribution will become due and will be received at the time of retirement or separation. At that time when the lump sum will be taxed, in that lump sum this amount is automatically being taxed at that time. So why to tax it right now? This is just now contributed. This is just now contributed. At the time of making the contribution, it is not becoming due and neither it is received. So it should not be taxable right now. It will become due as a part of lump sum. It will be received as a part of lump sum, and at that time it is already getting taxed. It is getting taxed at that time also, and it will be taxed at right now also. Don't you think one amount will be taxed twice? And we know that anyways this amount which the employer is contributing right now as a part of lump sum in the future, whenever the employee will get it, at that time we are going to charge this amount. So why to charge it right now? Hence it is fully exempt, even if it is contributed in UPF. So is your employer contributing in this year? Where he is contributing? UPF. Entire contribution fully exempt. Entire contribution, because as a part of the lump sum, whenever you are going to receive it in future, at that time it is already getting taxed. So right now it should not be taxed. Will you remember this? Now comes a very important part, this part. Is your employer contributing to your RPF account? Now tell me, simple thing I am telling you, if you are going to work for 5 years or more, if you are going to work for, and after 5 years, whenever you will get the RPF lump sum, will it be exempt at that time? Sure, no? Now for example, you have already worked for 5 years or more, and now you know that whenever you are going to get that lump sum from RPF, that time the lump sum will be exempt. So what you are telling your employer today, that employer, do one thing, give me less salary. Give me, and the salary which you are not giving me right now, no, contribute that salary to my RPF account. Employer will ask you, why? Employer, you will contribute right now, no, not becoming due, not received, hence not taxable. And as a part of lump sum, whenever that amount will come, at that time also it will not be taxable. So the taxable salary of this year, instead of taking that taxable salary right now, you will get it transferred to your RPF account. You will get it transferred to your employer will transfer your taxable salary to your RPF account. This year that amount will not be taxable for you. Why? Not becoming due, not received. It will become due in the future. It will be received in the future. And at that time, bloody, it will be exempt because you have already worked for 5 years or more. Tell me, every employee will start taking taxable salary like this. So there has to be some control that beyond this, if any amount is contributed by the employer, we will immediately understand that the employer is contributing your taxable salary in your RPF. Up to this limit, it is a genuine contribution. But above this, the contribution is your salary. This was your salary which is being contributed in your RPF, so that it does not get taxed right now also and not in the future also. Understanding? So tell me, how much should be the genuine amount? There has to be some limit. So limit they have given. Every year your employer should contribute to your RPF account up to 12% of your salary. 12% is genuine. So your employer's contribution should be how much? It should be 12%. It should be equal to 12% of your salary, or it should be less than 12% of your salary. What if your employer is contributing more than 12%? Up to 12% it is genuine. Anything over and above that, it will be assumed that your taxable salary is getting contributed right now. Hello? Right now we are going to charge that amount so that in the future, whenever you receive, it will be exempt, but at least in this year, this should be taxed. Because according to us, this was your taxable salary only, which you are telling your employer to contribute to your RPF. Now tell me, one example I am giving you. With numbers, please remember, very important. In the examination, if the salary question is there, 100% in that salary question, they are going to ask you this adjustment. And for this, you are supposed to be very, very, very careful. Your employer every year, your employer is contributing 2,50,000. How much? So what is your employer's contribution in this year? To your RPF account. See, employer contribution to SPF, employer contribution to UPF, any amount contributed in this year, fully exempt. Because as a part of lump sum, either it will be fully exempt if it is SPF, and as a part of lump sum, it will be taxable if it was UPF. There we don't have any problem. Because SPF, always genuine amounts will be there. UPF, whatever amount is there, whether genuine or ingenuine, at the end of the day, it is going to be taxed only. But RPF, there was a problem. What they are saying, that this year the total contribution is 2,50,000. How much amount your employer is contributing? How much amount actually your employer is contributing? 2,50,000. Is this amount becoming due right now? Is it received right now? So not taxable. And in the future also, as a part of lump sum, whenever this 2,50,000 will be coming as a part of your lump sum, that time also it will be fully exempt. Because it is coming from RPF. And you work for 5 years or more. Yes or no? So as a part of lump sum in future, this entire 2,50,000 will be exempt. But right now, you have to check whether this 2,50,000 contributed right now is within the limit of 12% of your salary or not? Now first of all you will have to calculate your salary. First of all you will have to calculate your basic, DA in terms, turnover commission. So this year, whatever was your basic, take that. DA in terms, take that. Turnover commission, take that. This is your salary. For example, your salary was 20 lakhs. Not 20 lakhs. The salary was 15 lakhs. How much? Basic, DA in terms, turnover commission. Salary was 15 lakhs. How much of 15 lakhs? 12% of your salary. So your salary was 15 lakhs, 12% of that. Meaning 1,80,000 should be the maximum amount which your employer should contribute. Yes or no? How much he is actually contributing? Is he contributing more than 1,80,000? How much? Now that excess 70,000 is there, no? According to the government, that excess should not be contributed. How much is the genuine amount? 1,80,000. Employer should have contributed 1,80,000 or less than 1,80,000. Then entire contribution would have been exempt, not becoming due, not received right now, not taxable right now, as a part of lump sum also fully exempt. Hello? If the contribution was only 1,50,000, if the contribution was only 1,50,000, not due, not received right now, not taxable right now, as a part of lump sum also 1,50,000 will be received, will not be taxable. Understanding? But how much amount your employer is contributing? Is he contributing only 1,50,000 or is contributing 2,50,000? Now 2,50,000 not due right now, not received right now, hello, not taxable right now. And as a part of lump sum also, not taxable at that time also. Entire 2,50,000 not taxable right now, and as a part of lump sum also not taxable right now. If there is no limit on this 2,50,000, then bloody all the employees will tell their employers to transfer their taxable salary to their RPF, like this only. So they have put a limit, and the limit was, and which in our case was 1,80,000. So your employer should contribute how much? 1,80,000. How much he is contributing? Ayo, how much is excess? 70,000 is excess. 17 subsection 1, definition of salary. In the beginning of the chapter, I told you the definition of salary. Don't go there right now. The salary includes wages, annuity pension, yes or no? Gratuity, fee, commission, perquisite, profit in lieu of salary, advance salary, leave salary. Point number 7. Any contribution by the employer to the RPF account of the employee in excess of 12%. That excess contribution will also be treated as your salary. So how much is the excess contribution? That 70,000 is your salary. And even that 70,000 will be taxable in this year. But sir, you cannot tax it. Why? This 70,000 neither becoming due right now, nor it is received right now. It is just contributed. This 70,000 will become due and will be received as a part of lump sum. Yes or no? So even this 70,000 is not becoming due and it is not received in this year. So even if it is treated as salary, still it will not be taxable. Why? Because it is still not becoming due, not received. So how to charge this amount? Section number 7. Section number in the second chapter. Residential status, scope of total income. We have done that chapter, no? There was section number 7, which I told you that I am not going to teach you right now. I am going to teach you with salary. Section number 7 talks about the items which are deemed as received in India. First item, any contribution by the employer over and above 12% of employee's salary even if it is contributed right now, even if it is not becoming due, even if it is not actually received right now, as per section 7, it is deemed to be received. So what will happen? Out of 2,50,000, out of 1,80,000 is exempt, neither becoming due nor it is received, so not taxable right now. As a part of lump sum also, it will be fully exempt. But what about that 70,000? As a part of lump sum, that 70,000 will also be exempt. But that 70 should be taxable right now. So to tax that 70,000, excess contribution over and above 12% of employee's salary, that excess is treated as salary. 17 subsection 1, that excess is treated as salary. And to charge this amount under the head salary in this year only, as per section 7, this is deemed to be received in this year only. Even if it is not actually becoming due, even if it is not actually received in this year, still it will be taxable in this year as your salary, because as per section 7, it is deemed to be received in this year. So as a part of lump sum, whenever this 70 will be received, at that time it will not be taxable, but today, in the year in which it is contributed, in that same year, it will be taxable as your salary. Because as per 17.1, it is salary, and as per section 7, it is deemed to be received. So it will be taxable in the current year itself. This amount should not have been contributed to your provident fund. Still it was contributed. So we will consider this amount as your salary, and we will charge it in this year only as your salary. But to do that, first let us make it your salary as per 17.1, and then to charge it under the head salary, let us deem it as if it is received in this year as per section 7. Will you remember? So what if your employer is contributing 5 lakh to your SPF? Fully exempt. And as a part of lump sum, whenever it will be received? Fully exempt. Because this was a genuine amount only. What if your employer is contributing 2 lakh rupees to your RPF in, to your UPF in this year? Fully exempt. Because as a part of lump sum, this 2 lakh will be anyways taxable. Yes or no? What if your employer is contributing 3 lakh rupees to your RPF account in this year? So you'll have to check the limit. What is the limit? How much the employer should contribute? He should contribute 12% of your salary. So first of all, you'll have to calculate your salary. Salary will include basic, DA in terms, turnover commission. You'll have to take 12% of that. So for example, your basic DA in terms, turnover commission, your salary was 25 lakhs. 12% of that, exact 3 lakhs. How much is your employer contributing? And how much is 12%? The contribution is within the limit, fully exempt. Right now not becoming due, not received right now, not taxable right now. Hello? Because it is within the limit of 12%. Within the limit of 12%, whatever contribution is there, yes or no? Not due right now, not received right now, not taxable right now. And as a part of lump sum also, not taxable. But what if your salary was only 20 lakhs? 12% of that? So how much your employer should contribute? How much he actually contributes? How much excess contributed? See, up to 2,40,000, not becoming due, not received right now, not taxable. In the future also, as a part of lump sum, will be fully exempt. Yes or no? Excess amount is? In the future it will also be exempt. But right now that 60 will be salary as per section 17.1. And not becoming due right now, not received right now, no problem. As per section 7, it will be deemed to be received, and that 60,000 will be taxable as your salary in this year only. Understanding? Will you remember? Done, sir. This was your entire discussion. Please read it once. Please read it once. And why it is taxable under the head salary? refer note. What will be written in the note? Come on, tell me. As per section 17(1), it is your salary. And as per section 7, it is deemed to be received. Hence, in this same year, it is taxable under the head salary. Understanding? Okay. Now, let's come to the interest credit. We'll have to apply the same logics, huh? Same. Interest is credited in this year to your SPF account. Whatever rate, whatever amount, fully exempt. Because not becoming due right now, not received right now, and as a part of lump sum, it will become due and it will be received later on. Hello? So if it is not becoming due right now, not received right now, interest is just credited to your SPF account. Only a credit in your account is given right now. So that giving the credit does not mean the interest is becoming due right now, it is received right now. So it will not be taxable right now. As a part of lump sum, it will become due and it will be received in the future. At that time also it will be fully exempt. Why? Because entire interest which will be credited right now will be a genuine amount. Credited at genuine rate. The government is not going to credit unnecessarily higher amount at unnecessary rates. Whatever rate which is prevailing, at that rate, whatever interest should be credited, only that genuine interest will be credited, and that genuine interest you are going to receive in the future. At that time it will be exempt. And right now it is not due and not received, only it is credited, hence it is not taxable right now. Understanding? What if the interest is credited to your UPF account? No need to worry about that. Interest is just getting credited. Interest is just getting neither becoming due right now, nor it is received right now. And as a part of lump sum, this entire interest will be taxable later on. Some interest will be taxable under the head salary as profit in lieu of salary. And some interest will be taxable under the head IFOS. Understanding? That entire interest anyways will be taxable in the future when it becomes due, when it is received. As a part of lump sum, this interest whenever will become due, whenever it will be received in the future, it is going to be taxed. So right now, why to charge it? Whatever amount of interest, whatever rate you put, the moment it becomes due, the moment it will be received, at that time it is going to be taxed only. So we don't have to bother right now. So any amount of interest at any rate credited in UPF will also be fully exempt. Will you remember this? Hello? Now there will be a problem in RPF. There will be a problem in interest credited to RPF in this year. Right now not becoming due, not received right now, you know, and you already worked for 5 years or more. So don't you think that whenever in future lump sum will come, in that lump sum, this interest will also come? And at that time it is going to be exempt because you are anyways going to work for more than. So after 5 years, whenever the lump sum will come, in that lump sum the interest will also come, that interest will be fully exempt. Don't you think you will tell your employer to credit more interest at more rate? Instead of getting a taxable salary right now, you will tell the employer not to pay you taxable salary right now, rather credit extra interest in your RPF account. So here also the control should be there. So what they are saying, how much should be the genuine amount of interest? Any amount of interest will be genuine amount if it is credited at a rate of 9.5% or less. So how much interest should be credited in your RPF account? Any amount should be credited, but the amount should be credited at what rate? 9.5% rate or less. Understanding? So let's take one example. Interest credited to your RPF account. Interest credited to your RPF account. Interest credited to RPF account. The interest is credited rupees 2,10,000. How much interest credited? But this 2 lakh was credited at the rate of 8%. So some amount will be there in the accumulated balance. On that accumulated balance, 8% was calculated and that 8% was 2,10,000. Understanding? How much interest should be credited? At 9.5%, it would have been more. So is the interest credited? Whatever amount of interest, it is credited at a rate which is 9.5% or less. This entire interest which is credited right now, neither becoming due nor it is received, and at the time of retirement, it will be coming as a part of lump sum. Yes or no? At that time also it will be fully exempt. Understanding or not? But what if this interest was credited at 11.5% rate? Wait. Please pay attention here. You are supposed to take. Now many students, what they do, they are superstars. Superstars, what they will do, they will take 9.5% of 2,10,000. Immediately I will ask for your SRO number. If you do 9.5% of 2,10,000, bloody that 2,10,000 itself is 11.5. Understanding? If the interest is credited at this rate, hello, and the amount of interest is this, how much interest should have been credited at? 9.5%. That you are supposed to do a cross multiplication. Cross multiplication. Understanding? 2,10,000 divide by 11.5 multiplied by 9.5 will be 470. Everyone got this? Meaning excess interest is getting credited. How much excess interest? 36? 520? Now tell me, simple thing I am asking you. How much is the genuine amount of interest? 1,73,478. Credited in this year, not becoming due, not received. So not taxable. As a part of lump sum in the future, fully exempt. Yes or no? What about this excess 36,520? Credited in this year, meaning not becoming due right now, not received right now. In the future, whenever this 36,522 will be received, in the future also this is exempt. But right now, this excess amount of interest credited is also treated as your salary as per section 17(1). This excess interest credited will also be treated as your salary. Sir, consider it as my salary, but still it will not be taxable, because if this is a salary, it will be taxable only if it becomes due in this year. It is received in this year. So nothing is happening in this year. Hence, section 7 says that it is deemed to be received in this year. So it will be taxable in this year only. So first of all, as per 17(1), it is salary. And as per section 7, it is deemed to be received in this year. So it will be taxable under the head salary. Later on, as a part of lump sum, when it will be received, at that time it will not be taxable. But right now it has to be taxed as your salary. Maybe this much taxable salary you are getting transferred as credit to your RPF account. This was your taxable salary which you should have received as salary in this year. But instead of receiving this amount as your salary, you are getting it transferred to your RPF account in the form of interest credit. We will not allow that thing to happen. If you are doing it, we will consider this amount as your salary only. Understood? Everyone, this is the end of your provident fund. Okay, pay attention here. Look at this. Look at this. Interest credited at any rate, any amount, credited to fully, and as a part of lump sum also in future it will be fully exempt. Interest credited to at any rate, any amount, credited to UPF, not taxable right now, because not becoming due, not received. But as a part of lump sum, it will be already taxed at that time. Yes or no? So no need to worry. What about the interest credited to RPF account? Now you will have to check. that whatever interest is credited, any amount credited, if that amount is credited to RPF account at a rate which is 9.5% or less, then it will be fully exempt. But if the interest is credited to RPF account in this year and the amount credited is credited at a rate which is higher than 9.5%, then interest amount credited at the rate of 9.5% rate will be, and any interest credited over and above that amount, excess interest will be, because it is a salary as per 17(1) and as per section 7 it is deemed to be received in this year, hence it will be taxable in this year. Note number 1. This note is applicable for both excess contribution to RPF, employer's contribution, and excess interest credited. For both the things, this common note is there. Any excess contribution by the employer to your RPF account or any interest credited to your RPF account in excess of 9.5% rate. As per section 17(1), it is your salary, and as per section 7, it is deemed to be received. Hence, it is taxable under the head salary in the current year itself. Will you remember this? Sure. Now, one simple question I would like to ask you. See, year 1, year 2, year 3, year 4, year 5, that's it. For 5 years, UPF account was maintained. Which account was maintained? First year, second year, third year, fourth year, fifth year. Every year contribution is happening to employees' contribution to UPF. Employers' contribution to interest credited to. Every year the contributions are happening to UPF account. Now after 5 years, what did I say? UPF account will have some balance, accumulated balance after 5 years. Can I say this is the accumulated balance of all these 5 years? In this accumulated balance, 5 years employees' contributions are there. 5 years employers' contributions are also there. 5 years, whatever interests are credited, those amounts are also there. Yes or no? So this accumulated balance is a UPF balance. This is a understanding. Now the UPF is getting converted to RPF. Now the recognition is given. Now see, if the UPF balance is getting converted into, so it is known as transfer. It is known as UPF balance will be transferred to RPF now. Meaning, there is no another account will not be opened. These balances itself will be recognized. So after 5 years, from now onwards, these balances will no more be known as UPF balances. These balances will now be known as what? RPF balances. Meaning the recognition is granted from very first day. Recognition to the balance means the recognition is granted from the first day, meaning first year itself. Getting my point? But the effect of RPF is not given from first year. For the first 5 years, the effects were given for UPF. Don't you think whatever employers' contributions were there, even if more than 12%, which was exempted so far, whatever interest credited to UPF, which were exempted so far, whatever rate, whatever interest, yes or no? So don't you think that the UPF accumulated balance is there? In this balance, for all the years, employer's contribution in excess of 12% is there. For all the years, interest credited in excess of 9.5% will also be there. Now out of this accumulated balance, no, in this year, what I will have to do, you know? The balances which are transferred from UPF to RPF, meaning the balances which are now being recognized, the UPF balance which is now being recognized, That is known as transferred balance. That is known as transferred. In this transferred balance, whatever employer contributions are there in excess of 12%, last 5 years, whatever amount the employer has contributed in excess of, that excess amount is also appearing in this accumulated balance, transferred balance. That will also be treated as your salary in this year. In this accumulated balance, interest is also there. For the first 5 years, any interest which was in excess of 9.5% rate, yes or no? Even those excess interest is appearing in this transferred balance. So in this transferred balance, the balance which is getting transferred from UPF to RPF, UPF to, in this accumulated balance, any excess contributions by the employer for these many years, any excess interest over and above 9.5% for these years, even that excess will be treated as your salary for this year. Becoming due, received? No, deemed to be received in this year. So will be taxable in this year, the year in which the recognition is granted. In that same year, those excess will also be taxed. Only then these balances will now be termed as RPF balance, because now the moment the balances will become RPF, and after some time the same balances you are going to receive from RPF, that time it will be exempt. We were thinking that the PF will remain UPF and we will be able to charge it tax because the balance will come from UPF. But bloody, your balances are no more UPF, they are transferred to RPF. Now the UPF balances which are converted into RPF, now they will be given to you. You are no longer going to get UPF balance, now you are going to get RPF balance, which are going to be exempted only. Hello. So till today, whatever effects you have given for UPF, those effects should be reversed. The effect should be given as if the effects are given to RPF. Understanding? So tell me, for all the years, whatever contributions are made in UPF, so UPF will have accumulated balance. Now this accumulated balance will be transferred and it will become RPF balance. So in the transferred balances, any contribution by the employer for these many years over and above 12%, yes or no? Any interest credited for these many years over and above 9.5%, you will have to take out those amounts. You have to consider these amounts also as a salary for this year. As per 17(1), these excess employers' contributions, excess interests credited for these years will also be treated as salary for this year as per 17(1) and will be deemed to be received as per section 7, and they will also be taxable in this year. This year means the year in which the UPF balances are recognized in that same year. Understanding? And from now onwards, the balances will be treated as RPF balance. Sure, sir? Should I move ahead? Wait, read this part. Just a moment, just a moment. Can you see transferred balances from UPF to RPF? Read it. Employers' contributions in excess of 12% of salary and interest credited in excess of, contained in such. So in that transferred balance, whatever employers' contributions are there over and above 12%, whatever interest credited over and above 9.5%, contained in that transferred balance, even that amount is salary and deemed to be received, will be taxable under the head salaries. Will you remember this? Sure, sir? Okay, very good, excellent. Now pay attention. This was the end of your provident fund concept. See, what is provident fund? The entire process you understood. Entire process of provident fund you understood. Then what are the types of provident fund? Did you understand this? What are the tax treatment of employees contributions, employers contribution, interest credited, then accumulated balance? What are the tax treatment? Did you understand everything? So this entire part we have done. Now important discussion on employees contribution to provident fund or RPF. Now see, this discussion becomes relevant in later on part. Later on part means which part? See, whenever I'll be discussing about that approved superannuation fund and that one calculation is there. This calculation is there. See, I'll tell you one calculation. Wait. Yes. There is one perquisite if you remember. Clause 7 and clause 7a. Clause 7 and clause 7a. At that time, this discussion is relevant. Okay. But before that, please pay attention. Please pay attention. What discussion is this? We'll try to understand. First of all, payment from a payment to or payment from, meaning the money is coming. Money is coming from, to which PF Act 1925 applies. Any provident fund to which PF Act 1925 applies, don't you think it is SPF? Statutory Provident Fund. So any payment coming from PF to which PF Act 1925 applies, the payment from that provident fund coming to you, lump sum coming to you, will be exempt under section 10(11). That we all know. Second thing, accumulated balance due and becoming payable to the employee participating in, that is also exempt. Meaning lump sum coming from RPF, in certain situations that lump sum is also exempt. Now the lump sum which is coming from SPF is exempt. Lump sum which is coming from RPF is also exempt. But don't you think that in that lump sum, employees contributions are coming? Interest on employees contributions are also coming. That entire amount gets exempt. Entire amount gets exempt. One amount gets exempt under section 10(11). Another amount gets exempt under section 10(12). So now they are saying, however, any interest accrued during the previous year on contribution of the employee exceeding rupees in the previous year in that fund on or after will not be exempt under section 10(11) or 10(12). Now the exemption which you were taking, you were saying that whatever amount coming from SPF, RPF, that entire amount is exempt. In that amount, don't you think whatever employees contributions are made, all the employees contributions are exempt? Interest on those employees contribution is also exempt. Full amount was exempt, yes or no? But from 2021 onwards, 1st April 2021, they are saying any contributions made by the employee, any contributions made by the employee during the previous year on or after 1st April 2021. So meaning whatever contributions the employee will make on or after 1st April 21, if those contributions are more than 2,50,000, if those contributions are more than, in the year, employees contributing how much? 2,50,000, sorry, more than 2,50,000. So any interest, what they are saying? Any interest which is accrued on the contribution of the employee in excess of contribution up to 2,50,000 and interest on that 2,50,000 will be exempt. As a part of lump sum, whatever contributions is coming and the interest on that contribution is coming is exempt. But in that lump sum, what did I say? In that lump sum, any interest is there. Any interest is there on the contributions of the employee which is more than. So contribution over and above 2,50,000. On that contribution, whatever interest is there, accrued, and now coming to you as a part of lump sum, out of that lump sum, this much interest will not be exempt. This will be taxable. So now your lump sum, no, you will have to, from your lump sum, you will have to find out this amount. And this is only after the contributions, only for the contributions which are made on or after 1st April 2021. Any contributions made prior to that, on full contributions, full interest, which is accrued so far, later on coming to you will be fully exempt. But whatever new contributions are made on or after 1st April 2021, you will have to make sure now the contributions you are making should be 2,50,000 or less. Oh, you are making more contribution. No problem. Make more contribution, but on that excess contributions made on or after 1st April 2021, whatever interest which is going to accrue and will be received as a part of lump sum, out of your lump sum, that much amount will not be exempt. It will be taxable. Understanding? Hello? So, starting from 1st April 2021 till today, employee contributes every year 4 lakhs, 4 lakhs, 4 lakhs, 4 lakhs. How much contribution employee is making? That contribution will come back, will not be taxable. But don't you think every year the contributions were more than 2,50,000? Hello? Every year the contribution was more than, by how much? Every year 1,50,000 more contributed, 1,50,000 more contributed. On that excess contribution every year, whatever interest accrued every year and accumulated will be received as a part of lump sum. At that time, out of that lump sum, this much interest will not be exempt. This will be taxable. Sure? Hello? So, if the contribution by such person is in a fund in which there is no employer contribution, then the higher limit of 5 lakh would be applicable for such contribution. Instead of 2,50,000, now you will check 5 lakh. If the contributions are happening to a provident fund where the employer do not contribute, meaning they are talking about public provident fund. Employer contribution is not going, only your contributions are going. And whatever contributions you are making, up to 5 lakhs. Up to, there you are not going to see 2,50,000. 2,50,000 is for those provident funds where the contributions by the employee as well as employer, both the contributions are made. But we are not talking about both the contribution. We are talking only about employee's contribution. On or after 1st April 2021. On those contributions, whatever interest are accrued and credited. And those accrued interest will be later on received as a part of lump sum. In that lump sum, that interest will not be exempt. The interest which is on the contribution over and above 2,50,000. And where the fund is a fund where the employers are not contributing, then the limit of your contribution will not be 2,50,000. The limit of your contribution will be 5 lakhs. Understanding? Next one. It may be noted that any interest accrued on contribution to such fund up to would be exempt without any limit, even if the accrual of income is after that date. Understanding? So whatever contributions made by the employee up to 31st March, on those contributions, whatever interest which was earlier accrued and which will be accrued later on also, on that interest, the exemption was earlier also available, now also the exemption is available. Done, sir? Now CBDT has notified Rule 9D. There is one Rule 9D which will tell you how to bifurcate this interest. Interest on contributions up to 2,50,000, interest on contribution more than 2,50,000. How to bifurcate that interest. So bifurcation is given in Rule 90, which prescribes the manner of calculating taxable interest relating to contribution in a provident fund or RPF exceeding the threshold limit. For this purpose, separate accounts within the PF account shall be maintained during the previous year 21-22 and all subsequent previous year. Earlier to that, only one PF account was maintained. Now from 21-22, this amendment has came. So from 21-22, separate accounts will be maintained. So in one PF account, two separate accounts. Contributions up to 2,50,000 and interest thereon. And contributions over and above 2,50,000, interest thereon. Two separate accounts will be maintained for employees' contributions. Up to 2,50,000, more than 2,50,000. So that at the end, as a part of lump sum, it becomes easier to identify the amount of interest. Getting my point? So all subsequent previous year for taxable contributions and non-taxable contributions made by a person. So first of all, non-taxable contributions account, and second one is taxable contributions account. First of all, non-taxable contribution account means non-taxable contribution account. In this account, closing balance as on. So whatever balances were there up to 31st March 21, those balances will be taken. In that, you will have to add any contribution made by the person in the account during the previous year 21-22 and subsequent previous year, which is not included in the, meaning up to 2,50,000. Whatever contributions now the employee will make up to 2,50,000, which is not taken in the taxable contribution, because anything over and above 2,50,000 contributed by the employer will go to the separate account, taxable contribution account. So you are supposed to take only that amount which is not going to taxable contribution account, meaning up to 2,50,000. Whatever contributions you are going to make from 21-22 and onwards, those accounts also you are going to add here. Yes or no? And now you are going to add what? Interest accrued on 1 and 2. On this, whatever interest accrued. On this, whatever interest accrued. And minus any withdrawal. So this will be non-taxable contribution account. So whatever balance in this non-taxable contribution account, this balance will also be given on retirement, will be fully exempt. And now in your taxable contribution account, what are you going to see? You are going to take all the contributions which you are making as an employee on or after 21-22 in excess of threshold limit. And what was the threshold limit? 2,50,000. So in excess of 2,50,000, whatever contributions you are making every year now will come under this account. This account is known as taxable contributions account. Yes or no? Now 21-22 and subsequent previous year. What about the contributions made prior to this? That is already considered here. See, because whatever contributions made up to 31st March 2021, whatever amount on that, whatever interest accrued so far and will be accruing in the future will not be taxable. So that you are supposed to consider as separately in your non-taxable contributions account. But any contributions which you will make on or after 1st April 2021, and that too also in excess of threshold limit. What is the threshold limit? 2,50,000. So excess contribution made by the employee will come in this account. Okay, and interest accrued on this excess contribution will also come in this account, minus withdrawals if any from this account. Now what will happen? Whatever balance which will remain here, at the time of retirement or separation, whenever you will get what? Lump sum. In that lump sum, this entire balance will not be exempt under section 1011 or 1012. This will be taxable. Understanding? But this is only with regard to employees' own contribution to provident fund, which is in excess of 2,50,000, and the contributions are made on or after 1st April 2021. So you have to make two separate accounts for that. One is non-taxable contributions account, another is taxable contributions account. Non-taxable up to 31st March 21. On or after 31st March 21 also you are supposed to take, but up to threshold limit. Everything you are supposed to take in non-taxable. Interest also consider there. Any withdrawal you reduce. In the taxable contribution account, what are you going to take? Only those contributions which you are making on or after 1st April 2021. In excess of 2,50,000. And on that, whatever interest is getting accrued, that interest will also be accumulated in this account only. Yes or no? And whatever withdrawals are made, reduce that. Whenever in future you are going to get lump sum, whenever in future you are going to get, in that lump sum, this amount will also come back to you. This will not be exempt under section 1011 or 1012. This will be taxable in that year. Will you remember this? Sure. Even if you don't remember, not to worry. These things are not asked in the exams. But since it was there, I had to explain. Okay. Hello. But remember, one small point I will discuss at that time. A small discussion about this will again come. Okay. Next one. See. Can you see exemption under section 1011 and 1012? 1011 and 1012. Give me 5 minutes. I am giving a break right now. 5 minutes. Is it okay? Or you want break just now? Immediately you want break? So I will think that this is done. Deemed to be done. Then stop making faces, okay? 5 minutes more. So you want me to give you a break right now, then I am giving, huh? Then I will assume as if I have done this. Yes. You want break? No? No? Okay. Now see. This exemption. 10, 11, 10, 12. Do you remember 10, 11? What exemption was there? What exemption was there? Amount coming from SPF. 10, 12. Amount coming from RPF. Exempt, no. Whether you follow 115 BSc or you don't follow 115 BSc, that exemption is available. But out of the amount which is coming to you, some amount will now be taxable. Taxable contribution account, non-taxable contribution account. Hello? Some amount will be taxable. And how much will be that amount? That we have already seen. Understanding? Now see, an important discussion about approved superannuation fund will also be there. Approved superannuation fund. This is just like provident fund. Just like who will contribute? Employee will also contribute. Employer will also contribute. Interest will be credited on a regular basis. And some amount will be accumulated and that amount will be given as a lump sum. But the fund is not provident fund. The fund is approved superannuation fund. Which fund is there, sir? What is the meaning? This fund is created for the benefit of the employees in the event of some unforeseen situations. Like what if employee meets with some accident and he is not able to work now, incapacitated to work. So to, give his family financial support, this fund is created. Out of this fund, the money will go to his family. What if he is not able to work? So out of this fund, a regular payment will be made to him, just like salary. What if the employee dies? So who will take care of the family now? He was the only bread earner at the family. So to give the financial support to the family, this fund will be used. So unforeseen situations or contingencies, to meet that situations, this type of fund is created. known as superannuation fund. But the superannuation fund, you have to get it approved. You have to get it approved from the income tax department. Now there are certain conditions which you have to follow, which you have to fulfill. Based on the fulfillment of those conditions, the approval will be given. And if you want to continue that approval, there are certain conditions which you are supposed to continuously fulfill. Only then the approval will be intact. Otherwise, the approval will be cancelled. So approval can be cancelled if certain conditions which are concurrent in nature, if you fail to satisfy those conditions. So first of all, you satisfy certain condition, we will give you the approval. And if you want to keep the approval intact, we are going to give you some conditions. Keep on following those conditions on a regular basis so that the approval remains. If you fail to fulfill certain conditions which we are putting, the approval granted can be taken away. It can be cancelled. Yes or no? So the fund should be superannuation fund which is approved. Approval is still there. So to the superannuation fund which is approved, will the employee contribute for himself? Will the employee contribute for himself? From where he will contribute? Salary is fully taxable. From that salary only he is going to contribute. Will you give any separate effect to this contribution under the salary head? No. Just take the deduction under ATC because the fund is approved. So in your approved fund, out of your taxable salary, whatever contributions are going, for that contribution you are going to get deduction under ATC. Getting my point? Will your employer contribute? Will your employer contribute? Give me 2 minutes for that. I will discuss about this. For your employer's contribution, whatever discussion is there, give me 2 minutes. Okay. Will the interest be credited here? Whatever amount of interest will be credited will be fully exempt because the interest is just getting credited. Okay. Next one. Will you get any lump sum? Will you get any lump sum from approved superannuation fund right now or in future? Fully exempt under section 10(13) if the lump sum is coming in these situations. Number one, on the death of the, meaning the employee dies, and whatever amount which is there in the approved superannuation fund is given to the nominees, legal heirs of the employee. Okay. So on the death, the amount is given as a lump sum. Then it is fully exempt. On to the employee in lieu or in commutation of annuity on his retirement at or after a specified age or on his becoming incapacitated prior to such. So usually what happens? From this fund, you are supposed to get a regular flow of income. Meaning, just like pension. Just like a regular flow of income will come. Known as annuity. Known as. But what you do? Once you attain that age, after attaining that age, you are going to get a annuity from this fund. You commute that annuity and you get a lump sum, fully exempt. Or sometimes what happens, even before getting that age, you become incapacitated to work. So from this fund, you start getting annuity. So you get annuity, then that annuity will be taxable as your salary. But if you commute that annuity, then that commuted amount, that lump sum amount will be fully exempt. So from approved superannuation fund, you will start getting annuity, meaning amount just like pension. Yes or no? You will start getting annuity once your age is 60. So you become 60 years old. Now you will start getting what? But instead of getting that annuity, you get it commuted. And you get a lump sum. That is fully exempt. Now sometimes what happens? The employer has promised that if your age is 60, from 60 year onwards, we'll start giving you what? Annuity. But wait. Before that, before the age of 60, if God forbid something happens and you are not able to work, you meet with some accident, or you become very ill and you are not able to work, meaning incapacitated to work before attaining that age. So the moment you will become incapacitated from this fund, you will start getting what? Annuity. You start getting. What if you commute that annuity also and you get the lump sum fully exempt? Understanding? So are you getting lump sum from approved superannuation fund? In this situation also exempt. In this situation also exempt. And by way of refund of contributions on the death of the beneficiary. So whatever amount which the beneficiary, meaning the employee, has contributed so far, that all the amounts are given back to the nominees on the death. So employees' contributions coming as a part of lump sum, yes or no, will not be taxable if they are given to the nominees as refund of contributions, yes or no. Then by way of transfer to NPS account. So if the amount coming from NPS is not taken in your hands, rather it is getting transferred to NPS, then also that transferred amount will be fully exempt. In all these cases, amount received as lump sum from ASF will be fully exempt. But to get this, first you will have to contribute. For that you are going to get deduction every year under section 80C. Every year the interest will be credited, that will be fully exempt. And every year your employer will also contribute. Now see, whenever your employer will contribute, where your employer is contributing? Tell me, employer's contribution is happening to? Employer contribution to ASAF account? Earlier what used to happen, earlier I am talking about 5 years back, whatever amount your employer is contributing to your ASF, in aggregate, if it is more than 1,50,000 per annum, 1 lakh, then the excess amount contributed to ASF used to be your perquisite under 17 subsection 2 clause 7. So clause 7 was there. Right now the clause 7 is also there, yes or no? But earlier in clause number 7, what they used to say? Any contribution made by the employer in ASAF account, which is in excess of 1,50,000 per annum. So in a year, employer should contribute how much? 1,50,000 or less to your ASAF account. Then it will not be treated as perquisite, fully exempt. Getting my point? But if the employer is contributing more than 1,50,000, then excess contribution over and above 1,50,000 to your ASF account used to be considered as your perquisite under 17 subsection 2 clause 7. But 5 years back now, they have changed that clause a little bit. And what they said, any contribution made by the employer to ASF account. Now along with that, contribution to NPS account and RPF account, all these taken together, aggregate amount. Now only the contribution to ASF account will not be checked. Along with the ASF contribution, if the employer is contributing to NPS also, RPF also, all the 3 contributions made by the employer during the year, aggregate amount. If this aggregate amount is up to 7.5 lakhs per annum, then it will not be treated as a perquisite. But what if it is more than 7.5 lakhs per annum? Up to 7.5 lakh will not be taxable, but the aggregate amount over and above 7.5 lakhs, what did I say? Meaning excess amount. the aggregate amount which is in excess of 7.5 lakh. Now this excess will be treated as your perquisite. 17 to 7. See, the individual treatment which you give to RPF, that you are supposed to give, over and above 12% will be taxable. Yes or no? NPS contribution made by the employer, fully taxable. That individual treatments you are supposed to give. But whenever you are talking about ASAF contribution, along with ASAF contribution, now you are supposed to take RPF contribution by the employer, NPS contribution by the employer, ASAF contribution by the employer. Now take the aggregate. Now this aggregate amount is more than 7,50,000. More than any contribution over and above 7,50,000. Any aggregate amount over and above 7,50,000 will now be treated as your perquisite. Now we will not check only ASAF contribution. Now we'll check ASAF along with RPF and NPS contribution. And the aggregate of all these three in the year is more than 7.5 lakhs. Then the excess over and above 7.5 lakhs will now be treated as your perquisite. And wait, the amount which is treated as your perquisite, can I say this excess is treated as your perquisite? On this excess, any accrued, any income, any interest or any income is accrued on this excess amount. Even that interest is treated as perquisite under 17 to 7A. So first of all, aggregate in excess of 7,50,000 is a perquisite under clause 7. Whatever amount is your perquisite under clause 7, excess amount, on that excess also whatever interest is there, getting accrued, that interest will also be treated as your perquisite under clause number 7A. Now, there is a formula to calculate this interest and how to determine that taxable amount, yes or no? And that formula, applying that formula, very complicated formula, and there is one question also on that in the ICI study mat. Okay, we are not going to touch that formula right now. We are not going to touch that question also right now. Even though I have given that thing in the notes also, my notes also. Okay, but we are not going to touch that right now. Why? Because if I touch that, you will go home and you will not come back. So what we are going to do, this part which is there, just now whatever I have taught, please remember this much only. Please remember this much. In my last lecture, what I am telling you, in my last lecture, when I will be finishing with the syllabus, if the time permits, then only we are going to do that. Otherwise, even if you don't do it, there is no problem. Don't worry about that. Okay? But I'll try my level best in my last lecture. If time permits, I will do that thing also. Okay? But right now, even if you do this much also, this is more than enough. This is sufficient. Everyone, understanding? Sure. Take a small break. Small break only, huh? How much? 1 hour. Take 1 hour break. We are meeting at 3:30, okay? Thank you.